now. So wild market swings have investors running to the security of dividend-paying stocks. Jeff Reeves is editor of InvestorPlace.com and MarketWatch columnist. He joins us now with 5 plays that have not only seen their dividends grow for at least 20, but will also, he says, keep shelling out bigger payouts through what could be another tumultuous investment year next year. Great to see you. Welcome. So, Aristocrats is how you're characterizing these particular names. What beyond, say, just issuing a handsome yield makes a particular stock an investment aristocrat?
Well, the Dividend Aristocrats are kind of this categorization of stocks that have increased their yield annually for the past 25 years, which means they're not just generating a lot of cash flow, they're doing a good job giving that back to shareholders. As you and I both know, there's a lot of dividend stocks that haven't been very nice to shareholders. I mean, Bank of America pays a penny a quarter, but with stock down 50% this year and the dividend a fraction of what it once be, I mean, that's not really protecting your shareholder interests. So these Dividend Aristocrats have a long history of giving money back to their shareholders more and more each year. S&P has this entire list of Dividend Aristocrats index. There's a couple dozen stocks on there, but I mean, obviously, as one of your last guests just said, not all stocks are going to go up. It's kind of a platitude, but it's true. It's a stock picker's market. You got to look at more than just the dividend. So some of these companies, not only are they increasing their dividends annually, but I think they also have a little bit of upside for shares. So it's kind of a win-win.
And Jeff, you narrowed it down for us. You've got 5 stocks in particular that caught your attention. So let's work through the list, beginning with Abbott Labs, ticker ABT. You've got a 3.6% dividend. It's paid dividends since 1926. That's some history, but with current news here, we know we're facing patent expirations across the board in the healthcare industry, pharmaceuticals rather. So what makes Abbott stand out for you?
Well, I like Abbott among big pharma stocks for a couple of reasons. I mean, number one, you look at the historical performance of the stock back 5 years. Your Pfizers, your Mercks, they're down 20, 30%. Abbott's actually up 14, better than the market. So long-term performance is pretty good. It's up strongly so far this year, almost 3 times the market. But going forward, you're right, patent expiration is a big deal. Abbott kind of has a little bit more lead time. Its Humira arthritis medication doesn't go off patent until 2016, which is a little more lead time than some of its competitors. And on top of that, it's been very proactive with its business model. It's planning this big spin-off of kind of its generic and medical device operations. They're going to spin off into one company, and then on the other, they're going to have branded prescription drugs. It's a pretty good idea. I don't know if it's going to work or not. A big pharma is trying to figure out what's going to come after the blockbuster age. So at least Abbott's not sitting on its hands. So
I don't mean to rush you, but I want to get through the whole list. We have a lot of breaking news this hour. I do apologize, Jeff, but let's talk about Coca-Cola. The white can was a total failure, but this is just a constant. It's a well, I don't know if you could call it a staple. It's really a discretionary name, but boy, what can Coca-Cola do wrong? Terrific company, terrific balance sheet, 2.8% dividend.
Yeah, and I mean, Warren Buffett loves the stock. He's got 200 million shares through Berkshire. I mean, if he's the smartest of the smartest money, so if you believe in smart money, believe in Coke. Also, Coke has a lot of good fundamentals going for it right now. I believe 8 consecutive quarters of year-over-year revenue increase, 10 consecutive quarters of year-over-year EPS increase. So fundamentals are good. Warren Buffett likes it. Good, sustainable dividend. It keeps coming back to you. So I like Coke in the long term.
And Pampers versus Huggies diapers. If you use Huggies, Kimberly-Clark is a stock for you if you have a little one, but also if you like a dividend.
Yeah, exactly. I mean, Kimberly-Clark actually has performed really well this year. It's outperformed Procter & Gamble, its biggest rival. Procter kind of had an edge on it during the recession as consumers kind of were looking for the cheapest option, but now it seems like it's got a little bit more momentum behind it. Kimberly-Clark does. A 4% yield, again, 25-plus years of annual increases, so your dividend's going to get bigger over time. Between that and the 14% roughly up year-to-date for Kimberly-Clark, I like that stock too.
And history can portend the future. If you've got a company with a history of increasing its dividend family dollars, certainly that company.
Yeah, and I mean, you guys were just talking a little while ago about how there's this differentiation between stores these days. You got your high end and your low end, and Family Dollar is the definition of a discounter. It doesn't have a yield that burns down the house. It's only 1.2%. But again, this is a fairly small company that's up and coming. Your yield on cost is really going to increase over the years if they continue to increase their annual dividend over and over again. So it's only 1.2% now, but the stock is up 20% year to date, especially after the earning report today from Dollar General. I think you got a lot of upside in shares.
And the final companies target 2.2% dividend. But here's actually my question. We've been hearing strategists, analysts tell us buy dividend payers for so long through this market volatility. How do you know if a company is overbought on that strategy?
No, I mean, you're completely right. Dividends are the most crowded trade in the market. I mean, let's not have any illusions that utility stocks or tobacco companies are going to grow at a 15 or 20% annual clip. It's just unrealistic. So, I mean, I think the trick with a lot of these companies is you try to find a strategic way into them. Target seems like it's had a very good holiday season. Say what you want about a lot of the other headlines. I mean, you can go either way on the Eurozone right now. It's nice that employment has an 8 in front of it. For once, the unemployment rate. Holidays headlines have been pretty good. So I'm going to go out on a limb and say Target because it seems like retail is coming back into focus while some of these big box stores have been out of favor. I think there's a pretty good chance that Target could have a pretty good fourth quarter. It's paid down some of its bad debt, which is a very important thing for these companies like Target that offer consumer credit cards within their business. So I think that's also going to benefit them long term. Okay. But you're right. I mean, it's really hard to pick a good dividend stock right now. That's why I encourage people to look at this history like the Dividend Aristocrats have.
Jeff, terrific information. We packed a whole lot into a short period of time. Thank you so much for your time this afternoon. Jeff Reeves.
Thanks for having me. Happy holidays.
Likewise.